This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Change at the top. Google's parent Alphabet rides a boffo profit report to a new title. World's most valuable company supplanting Apple. But as Henry IV said, uneasy lies the head that wears a crown.
Wild card, will Russia be the one to really change the path of oil prices?
Big week. Why the next few days could answer a key question for the market. Just how healthy is the American economy? All that and more tonight on Nightly Business Report for Monday, February 1st.
Good evening, everyone, and welcome. A major milestone for Google's parent, Alphabet. It's taken over Apple as the world's most valuable public company. It crossed that mark briefly today and solidified that position after reporting solid fourth-quarter earnings. Its first report as Alphabet, lifted by strong sales of online ads and tighter cost controls. The company whipped expectations, earning $8.67 a share. Wall Street was looking for $8.10. Revenue was also better than expected at more than $21 billion, an increase of 17% from last year. The results sent shares of Alphabet higher in initial after-hours trading. This was also the first report to separate Google's main search business from its riskier investments like self-driving cars, fiber, and glass. Josh Lipton has more on Alphabet's quarterly results.
$6.8 billion. That is one big number from the recent Alphabet report. It refers to the operating income at Google Core. And remember, that refers to search, maps, and YouTube, the real business drivers of Alphabet. What's different now is that the company is breaking out this number, stripped away from its other bets, such as Nest and Fiber and all those moonshots, so investors have a much cleaner look. Samit Sinha of B. Riley, an Alphabet bull, calls that $6.8 billion a massive number that beat his forecast. The number, he says, suggests that despite the competition from rivals such as Facebook, the company continues to perform well in its core businesses of display advertising, mobile advertising, and YouTube. For Nightly Business Report, I'm Josh Lipton in San Francisco.
That profit report for Alphabet and last week's equally impressive one from Facebook tees up a great debate. Which company deserves the pole position in your portfolio? Scott Kessler likes Facebook and has a buy on the stock. He's Deputy Global Director of Equity Research at S&P Capital IQ. And Max Wolf favors Google. He's Chief Economist at Manhattan Venture Partners, an investment firm based in New York City. Gentlemen, this reminds me of those high school essay tests where they say Google, Facebook, discuss, and that's really the whole mission here. Scott, why don't you take it first? It's not necessarily that you don't like Google, you just think Facebook has maybe a little more going for it and maybe a better price, I guess.
Right. So, Tyler, I don't think you can go wrong with either of these names, but I'll give you a few reasons for why we like Facebook more. First, we have a lot more growth. If you look at Facebook and what they delivered in the fourth quarter, I think it was a top-line gain of 52% if you adjust for currency, 60%, and that's really without any help from acquisitions or anything like that. Second is they have a number of levers for future growth, so think about video, Instagram, WhatsApp, even Oculus. So we think the growth story has a number of years to go. And then third is that they haven't really started the process of, say, allocating that capital to shareholders. Google started, Alphabet started last year with a $5 billion buyback. Facebook isn't even close to that process. So that's going to be another lever to generate shareholder value in the years to come.
All right, Max, take the other side and Google. You say Google is basically the next new thing.
Yeah, so look, I agree. Both of these are great names. Both of these should probably be portfolio elements to people who want growth with really consistent earnings. I think the next little while is Facebook. Facebook is the now company. I think Google is the next new thing. Facebook is the now thing. And I think usually, depending on what your investment style is, you want the next thing. So I think what Google's shown us is Google is a portfolio of the most likely to be successfully executed on startups with the lowest multiples while still throwing off enormous cash, a la the most recent report. I do think that Google is closing in on one of the hardest things to do and one of the things that only companies that are built to last have ever done, which is keep that engineering culture, keep plowing profits and earnings back into not just the next quarter or the next year, which Wall Street tends to favor, but really the deep out of the money ideas, whether those are self-driving cars or balloons providing internet. So I think Facebook is a great name. I think it still has more margin than Google for a while, but I think that Alphabet owns a bigger piece of the future because they take those chances, because they're more diversified, because they're more mature. They can sort of take chances that Facebook couldn't get away with, and that means they're a better long-term bet.
Max, let me push back just a little bit. I was speaking earlier today to someone who took the view that some of the things within the Google or Alphabet portfolio that, as you call them, out-of-the-money ventures right now, are sapping capital from the company, and that the capital allocation, not to use a fancy word, might be a little inefficient as a result. Do you see that as a weakness or a strength?
Yeah, so it's definitely true. I don't think it's a weakness or a strength. I think it's called innovation, right? So if you're not willing to spend a lot of money on a whole bunch of dreams, many of which won't come true, you're not really in the innovation business. And one of the hardest things to do is be a big behemoth company with huge revenues and stay creative and nimble without just buying things. And I think it's hard to do, but I think there's a good chance Google will be one of the few companies that does it, and that means built to last, and I love that for a portfolio.
Scott, what about Instagram and its role at Facebook? I mean, it seems to me that that is probably one of its most valuable assets right now because it goes across all different age groups, whereas Facebook does not necessarily do that.
Yeah, so I think that's fair, Sue. I remember, what was it, maybe a year or so ago, when Facebook was talking about concerns from a demographic perspective because younger users weren't flocking to Facebook and weren't staying on Facebook. Now they have an answer, and Instagram has become really arguably the biggest and most important social network for that younger demographic, say for teenagers. And so they're just really starting the process of monetizing Instagram. They're using new features and functionality to draw people in and to engage them. And then they're pricing advertising accordingly. We think that's an exciting new opportunity that's going to last years to come.
All right, gentlemen.
WhatsApp, too. WhatsApp is big with the younger crowd, and it's a major opportunity to monetize.
Are they making money off of WhatsApp? Quick yes or no, guys?
Not yet.
No, they haven't really even started that process.
That's the question there. They've paid $19 billion for it. I like it, but are you making money or not? Scott, thanks very much. Max, great discussion. We appreciate it.
Thank you.
Thanks a lot.
A new month, February started out fairly calm, especially compared to January. The major averages were down more than 1% early in the day, but then they climbed back. And when the closing bell rang, stocks were basically flat. The Dow Jones Industrial Average fell 17 points to 16,449. The Nasdaq rose six. The S&P 500 was fractionally lower. But what lies ahead for February, especially after the worst January performance since 2009? Deirdre Bosa looks at the past for a few clues about the future.
Good riddance January, hello February. Falling oil prices and worries over China's economy gave stocks their worst start to the year since 2009. But as investors look to a fresh month, history may be on their side. Over the last decade, February has been a better month for markets. The S&P 500 and the blue chip Dow Jones Industrial Average have been positive 7 of the last 10. And the best time to get in may be at the start of the month, according to Kensho, a data analytics platform for financial markets. Stocks reliably move higher and see better returns during the first 2 weeks of February.
I think investors will start finding that we've created some bargains in the first month of the year.
The best performing sector has been technology, followed by materials and consumer discretionary. After typically weak Januaries, they tend to make up lost ground during the first 10 trading days of the new month.
Over time, consumers, if they believe oil prices are going to stay where they are, they're going to be encouraged and they're going to be wanting to spend that money on discretionary items, whether that's restaurants or leisure or clothes, whatever the case may be.
There may also be opportunity in commodities. It's been an unusually rough start to the year for oil, but if you think the floor is in, crude has been a good bet this month. Oil has moved higher 8 of the last 10 Februaries and returned nearly 4% on average. Past performance is no guarantee of future results, but knowing the history may help wash out some of that noise from January as investors look to a fresh month. For Nightly Business Report, Deirdre Bosa, Vancouver, Canada.
Well, the month started with a number of multi-billion-dollar mergers. Abbott Labs to buy diagnostics company Alair for nearly $6 billion. The acquisition makes Abbott a bigger player in the rapid testing space, which helps physicians speed up treatments. Stryker is acquiring the privately held medical products firm Sage for more than $2.5 billion. Stryker also raised its earnings guidance for 2016. And the power producer Dominion Resources to acquire the natural gas utility company Questor for more than $4 billion.
It is a big week for the economy. It started today with new reports on how much Americans are spending and saving, and it will end Friday with a look at how many are working. And as Steve Leisman reports, the new information will tell us a lot about where things stand.
It's a week full of data that bulls hope will show gathering strength in the economy, but it got off on the wrong foot. Personal income reported for December today was okay, but spending came in below expectations, and construction spending in December also missed the mark with only a slight gain. The first data for January was also disappointing. A key survey showed manufacturing contracting for the fourth straight month.
We don't see a recession as being our base case for 2016, but we don't see really strong growth either. So it's really this chugging along, that square root shaped long-term subtrend growth that we're in right now.
There's still hope for the data this week. Auto sales on Tuesday and an important report on the service sector on Wednesday could yet show the U.S. economy is withstanding its considerable challenges. They include weak overseas growth, low oil prices that have devastated the nation's resurgent oil industry, and a strong dollar that's translated into pain for U.S. manufacturers. A top Fed official today offered a hint that the Fed could ease back on its hiking plans because of recent developments in oil prices and the dollar.
Further declines in oil prices and increases in the value of the dollar, foreign exchange value of the dollar, suggested that inflation would likely remain low for somewhat longer than had previously been expected before moving back to 2%.
Less inflation than forecast means a Fed that doesn't have to move as quickly as previously thought to hike rates. But Fisher remains optimistic about job growth. Markets will see if that optimism is well placed, beginning with the ADP employment report on Wednesday and then with the Friday jobs number from the government. The forecast calls for gains of 185,000 jobs in January. That's a marked cool down from the near 300,000 pace of December, but it's still enough to keep the unemployment rate unchanged or even edge it down below 5%. The key test for the week is whether the data show the weak fourth quarter growth continuing into the first, and if what were mostly foreign troubles are increasingly U.S. domestic concerns. For Nightly Business Report, I'm Steve Leisman.
Oil prices suffered their first decline in 5 sessions. Here we go again. Soft factory data out of China raised concerns about the outlook for energy demand, and that pressured crude, which settled down nearly 6% at $31.62 a barrel.
That low price of oil is hurting the finances of Nigeria, a major oil producer. Africa's largest economy has reportedly asked the World Bank and the African Development Bank for emergency loans totaling $3.5 billion. According to the Financial Times, the request will help fund a $15 billion deficit.
The Russian economy also getting hit hard by the low price of oil, and lately there's been a lot of talk out of that country about meetings to potentially support prices. But is that all it is, just talk? Or is Russia a real wild card in the energy market? Dina Gosofsky reports.
As oil prices continue to go south, Russia has been at the forefront of trying to figure out whether or not some kind of action, like a production cut, could be implemented in order to support and stabilize oil prices. An OPEC official recently even stated that it's all in the hands of the Russians now. So could Russia be holding a powerful card here?
We think Russia's a wild card because if you look at 2015, they really surprised many analysts by being up several 100,000 barrels. And the question for this year is, are they going to be up or are they going to be down? If they're up again this year, everyone's going to have to take their oil price forecast down. What I think is interesting now is you are for the first time getting some Russian producers, principally Lukoil, coming out and saying, you know what, maybe we should consider cutting production.
But some say it's much easier said than done.
I don't really see Russia being the one that's more willing to cut production on its side, and you have a lot of disagreement amongst Russian energy firms as well.
Several analysts we spoke with say Russia's role in a potential oil production cut is really just a sideshow, and that Russia is simply just trying to talk up the oil markets. Even if it does want to cut production without Saudi Arabia's cooperation, it would be all talk, little action, with geopolitics complicating things quite a bit.
When it comes to Russia trying to compel a Saudi cut, there's a lot of distrust there. And I think the Saudis are going to be much more focused on U.S. production than they are in coordination talks with Russia.
But some argue Russia has reason to do whatever it can to get other countries' cooperation, perhaps now more than ever. Like New York-based attorney Edward Mermelstein, who advises high-net-worth individuals investing in Russia and the former Soviet Union.
The price heading down into the 20s is going to impact Russia's economy even more significantly than where it is today, which is in dire straits.
Russian President Vladimir Putin himself has admitted that low energy prices have led to dangerous revenue losses, since Russia relies on oil and gas exports as the main drivers of its economy. That, a rising ruble, and economic sanctions have caused Russia's GDP to contract significantly. For Nightly Business Report, I'm Dina Gosofsky.
Still ahead, the big money behind the race for the White House. Iowa voters will caucus tonight. It's the first presidential nominating contest in a race like few we've seen before. There won't be any lines for voting booths, but rather public meetings. John Harwood tells us why it could be an historic night in the Hawkeye State.
We have finally reached the point in the American presidential campaign where it's not up to pollsters, it's not up to pundits, it's not even up to campaign speeches. Tonight, the voters begin to have their say in Iowa with the caucuses. And sometimes we forget that despite all the complex policy papers and issue stances that the candidates take, it sometimes for voters comes down to simple gut reactions to the candidates that they see in front of them. Let's take a look at a few that we picked up over the weekend in Iowa.
Voting for Clinton, pragmatic, progressive.
Marco Rubio, because he can unite people.
Ted Cruz, constitutionalist.
Bush and honesty.
Carly, confident, strong, and she has a blueprint for America.
Trump, wall.
We love you, Donald!
I love you too.
Yeah! Hillary, seniors.
Bernie, approachable.
Woohoo, Hillary!
My status right now is still undecided.
Now, those voters did get some stark rhetoric, especially on the Republican side at the tail end of this fight. Listen to this back and forth between Ted Cruz and Donald Trump, the two leading Republican contenders.
Both Trump and Marco are attacking me. They're attacking me with all their might. And we're drawing contrasts. And the contrasts are clear. And the contrasts, by the way, are substantive and policy-based. A vote for Marco Rubio is a vote for amnesty. And a vote for Donald Trump is a vote for Obamacare.
Ted Cruz is a total liar. I am so against Obamacare. I've been saying it for 2 years in my speeches. I'm going to repeal and replace Obamacare. I don't even know where he gets this, but he's a liar.
Trump comes into caucus night with a 5-point lead in the last Iowa poll, but Ted Cruz is believed to have a stronger organization. On the Democratic side, Hillary Clinton has a 3-point lead in that last Iowa poll over Bernie Sanders, but she is believed to have the stronger organization, so she's considered the favorite going into tonight. The results here, however they come out, are going to shape the contest as we move forward to New Hampshire, which has its primary in 8 days, then Nevada and South Carolina after that, and then the race goes national. For Nightly Business Report, I'm John Harwood in Des Moines, Iowa.
Well, the money is rolling into the presidential campaigns. Total contributions for the fourth quarter have been filed. We got the numbers, giving voters a look at the financial health of each candidate's war chest. Eamon Javers has been going over the data. What did the numbers show, Eamon?
Yeah, hi, Tyler. This is much different than what we've seen in past years or in past quarters here. It's such a different race this time around. Let me walk you through the numbers starting on the Democratic side of this campaign. We see Hillary Clinton topping the list here with $38 million raised in the fourth quarter. Also, Bernie Sanders with $33.6 million. On the Republican side, Ted Cruz, $20.5 million. Marco Rubio, $14.2 million. And then there's Donald Trump at the bottom of this list of three, $13.6 million for Donald Trump. But what's astonishing about this is that this is not the kind of a race we've seen before, because we've got a guy in this race who is leading this campaign and who is self-funding his own campaign. So contributions matter less to Donald Trump than they matter to all these other candidates who will depend on them like oxygen to keep going after the Iowa caucuses today.
He's made that point that he doesn't need funding, but people are still giving money to him despite the fact that he's a billionaire.
Yeah, and that's what's astonishing here, Sue. You see a lot of small donations here going to Donald Trump, $50, $100. Lots of those donors, even though the guy is a billionaire and says he's going to write his own checks anyway. What you don't see in Donald Trump's case is a lot of people maxing out, giving the total maximum amount of money to the Donald Trump campaign. That means a lot of the big money people in traditional politics are not writing checks to Donald Trump. A lot of smaller people are. That's a measure of enthusiasm for the Trump
Quick
campaign.
thought here. I was stunned how close Bernie Sanders was to Hillary Clinton. Can he keep it up and raise establishment-sized money?
Yeah, he's definitely hitting his marks so far. He's raising enough money to stay competitive. Hillary Clinton's got all these outside groups working for her, so she's got a big advantage. But Sanders is definitely in there in this money race right now.
All right, Eamon, thanks very much. Eamon Javers in D.C.
Twitter gets a lift on takeover speculation, and that's where we begin tonight's Market Focus. A report by tech website The Information said investor Mark Andreessen and private equity firm Silver Lake Partners have, quote, considered some sort of deal with Twitter. But then a follow-up by Fortune reported that Silver Lake has no interest in buying, quote, even a slice of Twitter. Nonetheless, shares were up more than 6% today to $17.91. Lumber liquidators will pay more than $13 million in fines and penalties for importing illegally sourced wood. In October, the hardwood flooring retailer pleaded guilty to felony and misdemeanor charges. Under its plea agreement, the company will also face 5 years probation. Shares of lumber liquidators were up 3.5% today to $13.36. The Centers for Disease Control and Prevention is closing its investigation into the Chipotle E. coli outbreak, saying the concern appears to be over. But the CDC was unable to determine the cause of that contamination, saying that it was likely because of a, quote, common meal item or ingredient, end quote. Chipotle expected to report its fourth quarter earnings tomorrow. Shares rose more than 4% to $472.64.
Fourth quarter profit at the health insurer Aetna up nearly 40%, thanks in part to membership growth in its government-based business that sells Medicare and Medicaid plans. Aetna did, however, issue a downbeat outlook for 2016, citing an expected drop in enrollment and a rise in medical costs. Aetna shares up 1.5% today to $103.37. The activist hedge fund Hudson Executive Capital has taken a small stake in CIT Group and wants the firm to break up. That, according to the Wall Street Journal. CIT Group provides commercial lending and insurance services and also owns planes and rail cars it leases out. The lender currently exploring a spin-off of its commercial air business. Shares of CIT up nearly 2% today to $29.86. And Mattel beat fourth quarter earnings targets, pulled in $2 billion in sales. That revenue number also better than expectations. Strong sales for its Barbie dolls and Hot Wheels toys lifted those results. It was Mattel's first rise in revenue in more than 2 years. And just like the new Barbie, Mattel shares plumped up on the news in extended hours after falling 3% during the day to $26.76. And coming up, we go a different direction. The marijuana industry is growing quickly, and so are the headaches when it comes to paying taxes.
Legal marijuana sales, both recreational and medicinal, are hitting a new high of nearly $5.5 billion last year. A new report predicts sales this year will grow 25%, and by 2020, sales are expected to hit about $22 billion.
But for those who sell marijuana legally, filing business taxes is anything but simple. Jane Wells takes a look at this growing issue for a new crop of entrepreneurs.
It's tax time in the cannabis industry, and for many new in the business, their IRS bill could leave them dazed and confused.
Companies in our business are paying anywhere from 40, 50, 60, 70%, depending on what demographic they happen to be in.
Even though marijuana is illegal at the federal level, the IRS still insists these companies pay income taxes. At the same time, the agency bars them from making most normal business deductions.
You know, you could end up with a tax bill far more than any potential profit you could ever make.
Jeremy Carr owns a dispensary in West Hollywood and said that could start to happen as legalization is bringing down prices and margins.
I've seen the profit margins drop about 40% in the last 5 years.
Here's the irony. The IRS does allow deductions for the costs of growing marijuana, but it does not allow deductions for the retail costs of selling it, things like rent, advertising, payroll.
You know, fortunately, the margins are there, at least in Northern California where we operate.
Derek Peterson left Wall Street to start TerraTech, a publicly traded holding company which owns a variety of cannabis companies, including the Bloom dispensary in Oakland. But TerraTech also owns other companies which don't directly involve pot, like one which provides growing equipment or a firm which sells regular produce to retailers. He makes sure businesses are segregated in their tax reporting and puts as many costs as legally possible into areas where deductions are allowed.
A lot of the business still is one leg in the black market. We're not able to do that because we're a publicly traded company and everything's audited on an annual basis. But there's a lot of providers out there that are, because of this headwind, are still operating with one foot in the black market, one foot in the more overt and regulated market.
Those trying to be legit accuse the IRS of hypocrisy. Tim Cullen owns the Colorado Harvest Company in Denver, which did about $10 million in sales in 2015. He says the lack of normal deductions will cost him $1.5 million more in taxes.
If we're licensed and legal in Colorado, that should be good enough for the IRS, but they certainly cash our checks every month.
For Nightly Business Report, Jane Wells, Los Angeles.
That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And thanks for me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we will see you back here tomorrow on Groundhog's Day.
Oh, that's right. I forgot. Tom Smith.